Dollar risk premium re-emerges as US policy uncertainty rattles global market. By early February 2026, global financial markets are grappling with a familiar yet unsettling phenomenon: the quiet but persistent rebuilding of a US dollar risk premium. Amid a relentless stream of disruptive headlines from Washington, investors appear to be demanding extra compensation for holding dollar-dominated assets, an unmistakable signal of eroding confidence in a predictability of US economic and policy direction. The warning signs become most visible during last week's abrupt sell-off, when US equities bond and the dollar weakened simultaneously, while currency depreciation can often be justified by economic fundamentals. This episode carried the hallmarks of something deeper. The dollar fell sharply against the euro and other major currencies, even as US interest rate advantages This episode carried the hallmarks of something deeper, an anomaly that traditionally raises red flags in foreign exchange markets. Risk premia, by definition, capture uncertainty that cannot be fully explained by growth differentials, inflation expectations, or interest rates alone. In currency market, this usually manifests in two ways: exchange rates drifting well beyond fair value estimates and movements that defy what interest rate spreads would normally imply. Both patterns are now reappearing in the dollar. Markets have seen this movie before. In April last year, tariff shocks triggered fears of capital flight from the United States, pushing the dollar lower despite a growing yield advantage over Europe. Although those distortions faded as 2025 progressed, they have returned in early 2026, this time fueled by renewed geopolitical tensions, trade confrontation, and mounting concerns over the independence of the US Central Bank. At the center of these anxieties is the perception that the administration of Donald Trump may be comfortable with the weaker dollar as part of a broader global trade reset. Last week, the greenback slid to four-year lows against the euro and stumbled against the yen after US authorities publicly scrutinized dollar-yen trading levels, a move widely interpreted as a veiled warning of tolerance, if not intent, toward currency depreciation. Market volatility underscores that concern. 1 month implied volatility in the euro-dollar pair spiked to its highest level since last May, hovering near 10%, a clear sign that traders are bracing for sharper currency swings ahead. The nomination of Kelvin Rush as the next chair of the Federal Reserve offered a brief reprieve, lending support to the dollar on hopes that monetary policy may resist political pressure for the aggressive rate cuts. Yet that relief rests on a fragile assumption that the frenetic and often unsettling policy signals from Washington will begin to stabilize.